Good afternoon. Hope everyone is doing well. It's Friday, 2 p.m. Eastern time. What a week. Don't call it a comeback. The market is now at all-time highs. Super exciting. I have a few topics I wanted to share with you. But before we do that, we can honor the moment with this flashback from the late 90s. It's from an analyst who is a contemporary of Peter Lynch. His name is LL Cool J. Have a listen.
Come on, man. And with the local DBC news, LL Cool J with a triumphant comeback. For a scene. But tonight, don't call it a comeback. I've been here for years. I'm rocking my peers, put suckers in fear, making the tears rain down like a monsoon. Listen to the bass go boom, explosion. Overpowering, over the competition. I'm towering, wrecking shop. When I drop these lyrics that'll make you call the cops. Don't you dare stare, you better move. Don't ever compare me to the rest that'll all get sliced and diced. Competition's paying the price. I'm gonna knock.
Don't call it a comeback. What a comeback. Pretty amazing comeback for the markets. All the major indices at all-time highs, right? There's a lot of people talking about fading US exceptionalism. The indices are at all-time highs. It's really quite extraordinary. Hope you all are enjoying the ride here. I want to share a few topics. One is just a few more minutes on stablecoins, share some of the highlights from a conference I was at recently in New York called Permissionless. I want to do a quick review of different sectors in the market, share some macro data I'm looking at, and then I want to do a deep dive on Norwegian Cruise Lines. Usually I do very broad kind of topic review. I'm going to go just hardcore deep on one name. I do this now and then, but it'll give you a good perspective of how we look at things at Lumida Wealth. I think it'll be a lot of fun. So if you're more analytically oriented, that should be a lot of fun, and we'll cover off on the broader topics. Before we do that, though, I did want to share this excerpt. I think what I'm trying to do is pick a random book off my shelf, flip to a random page where I had an underline, and just share a quick thought. It's good to, I think, zoom out and get perspective on things. This is from Ralph Waldo Emerson, another great American. We got July 4th coming up. I shared an excerpt from John D. Rockefeller, Letters to My Son, which I recommend you all read. Getting into the mindset of a great entrepreneur, it's really quite something. And I keyword on underscore mindset. He's also talking about deals he's done. Those of you that listen to How I Built This by Guy Raz or Acquired or Startup, this is the OG version of that, John D. Rockefeller. So listen to what he has to say. But check this out. This is more on the philosophical side rather than the entrepreneurial or investing side. He says, man is a stream whose source is hidden. That's a powerful statement just by itself. I could put that on the wall and just think about that with an espresso. Man is a stream whose source is hidden. Our being is descending into us from we know not whence. I am constrained every moment to acknowledge a higher origin for events that the will I call mine. As with events, so it is with thoughts. When I watch that flowing river, which out of regions that I see not, pours for a season, it streams into me. I see that I am a pensioner, not a cause, but a surprised spectator of this ethereal water that I desire and look up and put myself in the attitude of reception, but from some alien energy, the visions come. This is really quite extraordinary. I read that 3 times, by the way. You think about the opening of the Iliad, they talk about this concept of the muse, and the bard is telling a story. The bard doesn't know where the story is coming from. Think about the hard problem of consciousness, which is a more modern version of that. It's the idea of where does subjective experience come from? You have this matter, you have physical architecture and molecules and components and interactions, but none of that implies subjective experience or agency or senses. I think he's speaking to that. He's speaking to the idea of perception. Anyway, in a different life, maybe a different time, I'd love to talk about philosophy all day long, but let's get back to markets. Yeah, NCLH is only getting green candles. I'm excited to talk more about that. We'll have fun on that topic. So, a few quick things just on the geopolitical risk. Look, the main lesson is fade geopolitical risk. Fading geopolitical risk is usually a pretty good idea because it doesn't impact earnings. It creates risk aversion in the short term. And you have two countries like Iran and Israel. Israel's stock market was at all-time highs during this conflict, kept going to all-time highs. They're closer to the problem than we are. That's one. There's no impact to earnings. Number two. Anyway, I hope you're watching the Lumina Ledger. We're writing about this. We also wrote that Trump was likely to use the bunker buster bombs, following the cue from Marco Rubio, who's a hawk, as well as Hegseth, who's also a hawk, and wanted to equip Israel with the bunker buster bombs. The hard part wasn't getting that call right, though. The hard part was seeing that they would drop the bombs, but you should still be buying the market. That's the hard part, actually. Because if you thought they might do that, then you might say, oh, gee, it's risk off, that people aren't going to expect that, right? So it reminds me a lot about 2023. We had a view that the Fed would keep rates higher for longer, and that might make you bearish. Actually, no, it's bullish. Fed keeps rates higher for longer, that's bullish because the economy is stronger than people think, which is where we stand today. Still hold the same view. Why are rates higher for longer? Because I think real economic growth is better. Productivity rates are strong, and inflation's on the decline. So there are a lot of good stories out there. I was dropping my son off at summer camp today. I tune into Bloomberg as I do when I'm driving, just to pick up what people are saying and the consensus is saying. And someone was asked, this analyst, they said, "Hey, why is the market going up?" And the person answered, "Well, it's the absence of negative catalysts." It's like, what the hell are you talking about? The absence of negative catalysts. That's a PTSD type response. That's a closet bear. The absence of negative catalysts. I'll give you some catalysts. Here's some catalysts. One, you've got easing of the geopolitical risk. The people that sold into that risk now have to buy back into the market. That's why you're getting this reflex bounce. Number one. Number two, the AI trade is back. NVIDIA's at all-time highs. People believe in the story. Corporates are adopting AI. Startups are adopting AI. The software engineers getting laid off due to AI are starting AI startups embracing AI. China's embracing AI, right? So, that's a real story. Folks are offsides. They're underpositioned. They're underweight. They have to get back in the market. That creates a bid. They're still underweight. The long-short ratio for hedge funds is at the 19th percentile on a one-year look back. So, they're offsides. If you look at various sectors, it's just hard to find a sector to get bearish on. Maybe in a month that will change, but from where I see, I just don't see that. This is the theme I've been coming back to the last several podcasts. We cycle through these sectors, and it's just hard to find where's the weakness. I'm trying to find the weakness. I'm trying to find the bear case. I can't. It's hard to find. So it's not hard to find the bearish psychology, though. What else? Is bad data bad? No, bad data is good because it means the Fed will cut rates. Is good data good? Yes, the good data is good. It means that there's continued economic growth with a backdrop of declining inflation. So I'll share this screen too. This is quite interesting. I saw this from Bespoke. I'll share it on the screen here. This shows the Russell 1000 industry groups and their short interest as a percentage of float. Now, on average, stocks that have higher short interest, on average, they do lag. However, that's not been the case the last few months. I'll pull up the Lumida factor model. You can see this is our in-house technology. One day, this will all be in an iOS app. We're actually posting a role for iOS developer so we can make all of that a reality. You can see here the different factors that we look at. And This is still under development here, so bear with me around this. But so on average, 1 second, sorry, it's populating here. Oh. This is pretty cool. But basically what this does is it identifies factors that are working and not working. So today, highly shorted securities are not working. That's interesting. Animal spirits are leading the pack again. They've been leading the pack over the last 1 year or so too. So this is the Twitter phenomenon. This is what I was mentioning yesterday. I saw Tom Lee speak at the permissionless conference, and he mentioned, I got to work on, that's really good feedback. Thank you, Mike. We got to get charts that are kind of oriented differently in the color spectrum. Thank you for that. But he mentioned that you've got businesses led by CEOs who are turning shareholders into customers. And he talked about a few of these. I think it's a real phenomenon that's happening. He mentioned HIMS, he mentioned Palantir. I could say, yeah, it's also true for Reddit. It's true for Amazon. There's a number of companies that have figured that out and are leaning into that. Warren Buffett was the first person to do this, of course, to create community and the commingling of community and capital. He did that with in-person events and through old school media publishing, but it's happening on social media too. It's happening with digital assets. It doesn't mean that all those assets go up into the right, but there is a social media premium or discount around an asset. I think you have to be aware and to be conscious of that. And so we see names that have high short interest that have this social media premium, and they're getting squeezed higher. And you saw that last year or 2023 with Coinbase and Carvana, for example, right? That phenomenon is happening in other areas too. So I think you've got to be very aware of that and consider that in your approach. So back to these sectors. I'm going to go share the screen again and show sectors with the highest kind of short interest content. You've got autos, you got consumer discretionary, consumer durables and apparel, semis, and transpo. And on the bottom, you got insurance. Now, interesting thing about this list is those names at the top were the most negatively impacted from tariffs. Autos, 25% tariffs on Mexico and Canada. Consumer discretionary, well, these are retailers that import merchandise from China or Vietnam. Consumer durables and apparels, washing machines, dryers, manufacturing, they're all impacted. Semiconductors, that's impacted also. What's the least impacted? Insurance. These are balance sheet businesses. It's not about import export. It's about cost of capital and return on capital. You'll notice this is lagging now. It's lagging because investors were hiding in this category along with some other categories down here. And now they're rotating back into these cyclical categories that were tariff exposed. Isn't that interesting? So if you pull up, say, I'm not a big fan of department stores. I think they're in secular decline. But even like Kohl's is rallying. This is KSS. It's been rallying. It's at $8 now. You know, it's up 1.26%, beating the S&P. I wouldn't want to own that per se, but my old friend ANF, this didn't work for us at the beginning of the year, but it's working now. We have a position here. We reestablished a position here. It's up 3% today. But these retailers were destroyed with the onslaught of tariffs. And so much bad news has been priced in. Same thing with Nike, right? Nike went up a good amount yesterday, in part due to the idea that the impact from tariffs would be less than people thought. So you're seeing these catch-ups and mean reversions that are playing out there. And for that reason, it's hard to find a category to get really bearish on. What you might see is like a rotation from what's been working to other areas. That's possible. You you look at mortgage rates coming down. Housing starts have been bad, and yet home builders are going up today. They're up 65 bips today. That's kind of interesting. There's bad news, but these names are going up. The names are getting cheap. So what about financials? I wrote about this the other day. Okay, you have many bank stocks that are below where they were just prior to the November election last year. They're cheaper then, they've got more earnings, and they're not all-time highs, despite you got deregulation coming, capital relief, and you've got tax cuts. Not just the extension on the tax cuts, but you've got tax cuts on sub 150K income coming. Delinquencies are dropping, including in subprime cohorts like Synchrony or Capital One, for example, right? So where do you get bearish there? What about the high-end consumer? Well, record balance sheets. I don't see it there. Healthcare has been weaker. Again, I think that's because cyclicals are outpacing defenses. But healthcare, you've got cheap businesses that are growing earnings, and once this Medicare, Medicaid lack of clarity gets resolved, those should do fine. Or in the next rotation, when tech gets overbought, maybe in a month or so, those should benefit from rotation. So it's really hard to find a sector where you can get bearish. Where is it? I'm trying to find it. You've got dollar weakening that helps international value stocks, that helps exporters. Lower rates helps small caps, right? So there's a lot of interesting things that are happening out there that are actually constructive. Consumer confidence data came out. It's higher than people thought. So people are coming out of their shell. And that's why I think names in the consumer discretionary sector are especially interesting, because not too long ago, they were priced in for a recession. If there's no recession, then that was an overshoot. I believe that's the case. So let's see. I love the questions here. Thank you for that. Yeah, I'm not into coals either, but I wouldn't be surprised if it goes up anyway. I wouldn't be surprised if it goes up anyway. I think retailers in general could be interesting. Let's see. Let me jump back into the agenda here. So what else? Apollo. Let me share the story with you. I had a good chat with Christine Moy, who leads their Apollo crypto and AI team yesterday. And she was sharing that they've got, Apollo assets on chain now. I shared a video a few days ago talking about how stablecoins are going to transform lending even to Main Street. People are talking about the payments impact. That alone is a big impact. Stripe is charging 2.9% per transaction plus a transaction fee. Visa's a part of that. MasterCard's a part of that. Card issuers are part of that value chain capturing that. If you can move money with stable coins, those profit pools are at risk. Then on the lending side, you have banks that pulled back from lending. Now you've got dollars that are on chain. There are investors on chain that are looking for yield. Investors on chain look for one of two things. Either they want to go degen in high risk, high beta securities or tokens like hyperliquid, I guess, or they're hiding out in USDT or USDC, just protecting capital. That's kind of what they do. And when they hide out here, they want to get a yield on their stablecoin deposit. And the way that yield is generated is through these things called liquidity pools. And those liquidity pools have to originate yield somewhere. Sometimes that's through what's called the basis trade. For people that are into digital assets, you'll know what that means, the spread between the futures and the spot. But more and more, it's going to be real world assets. So now, get this. You can take a stable coin and invest in Apollo, private credit fund, ACRED, and get something like a 10, 11% yield on chain. It gets better. You can loop it. I'm not saying you do this or not. This is not financial advice, it's just entertainment. Okay. But you can loop it in the same way a bank will have a return on their assets through leverage, meaning you can take your investment in ACRED, you can use that as collateral to get more USDC as proceeds, borrow on another protocol like Morpho, at 1.5%. I don't know why it's a 1.5%, by the way. It doesn't make any sense to me. If someone can share that, I'd love to hear. Or someone ask Grok and let me know. But anyway, you can borrow at a low rate and then invest again in Apollo. And now you've got an all-in return of 15 to 16%. Non-mark-to-market, private credit, on-chain, tokenized, transform the ordinary income to long-term capital gains. That would be the trifecta if you can pull that off, right? Again, I'm not saying people should do that. All I'm saying is that you're going to see more of that happen. You're going to see more of that happen. I'm looking to tokenize some oil and gas assets that we recently acquired in Alberta, Canada. They have a double-digit free cash flow yield. I don't want the K1. I want to put into a token. I want to transform it to long-term capital gains. I'd love to sell a senior piece off of it, create some structural leverage. Those are interesting opportunities that are going to happen with on-chain finance. In the old world, you'd have to call an investment bank like Jefferies or Goldman Sachs, pay points for structuring, points for placement. You didn't get regular liquidity. You didn't have low level transparency if you're the buyer. You had to spend $500,000 in legal fees. So, this on-chain finance is real. It is transformational. Yes, something will go bump in the night down the road. I don't think that time is right now per se. But more dollars are flowing on chain, and that those dollars will find their way into lending. So it's a really dynamic time, and it's worth learning more about. Let's see. So I think one headline I have for this is welcome to small cap summer. Welcome to small cap summer. I think that's going to play out. I think with declining rates and an improving U.S. Consumer confidence, lower taxes coming, animal spirits strengthening, small cap stocks being the default short of hedge funds that now need to cover their gross long is already maxed out. They can't buy more. What they can do is cover. They're going to cover small caps. That means they're going to buy small caps. I think small cap summer is here. And with that said, I will do a deep dive into this Norwegian Cruise Lines. Let me know if you have any other questions here. Okay, got a little macro question. Continuing jobless claims keep going up, and 60% job creation is still in the healthcare sector. Do you have any worry that the Medicaid cuts in Big, Bold, and Beautiful will derail growth later in the year? So I think one reason why continuous jobless claims are going higher is that post-COVID, there's a sector of the economy where their relationship with work has changed. There are people that they get a job, they look to get fired, and they go back on unemployment. By the way, that's a thing that happens. I'd love to quantify how much that happens, but I've talked to enough small business owners where I see that, see that phenomena, and I don't think people think about initial claims data that way. But that's a consideration. They haven't been spiking. That's the first thing to look at. They're not above 300,000 or so. We'll see how the bill actually plays out. I can tell you that a lot of the bad news is priced in. That's one. Two is you got elections coming up. I don't think Republicans will take an axe to that. We'll see. We'll have to see. I don't think it's going to derail job growth either. I mean, healthcare continues to be a large component of the economy, and it's one of the few categories that keeps growing year after year after year. It has to with Asian demographics. Even elective health is quite an interesting category. Leaving aside Medicare and Medicaid, like elective health is a growing industry too. So that's my take on that. I just don't expect the growth in healthcare spend to suddenly stop. Okay, so let me deep dive into Norwegian Cruise Lines. The way I look at an opportunity is I always start off qualitatively first. first thing you have to do is say, who's the customer? Tell me the quality of the customer, I'll tell you the quality of your business. And then look at the market, look at competitive positioning. Then you get into the numbers, right? So this idea is part of our baby boomer theme. I love this idea of following the baby boomers. Where are they spending money, right? The baby boomers have $60 trillion in assets. They're shifting from consumption to spending. They're spending on things like travel and leisure and restaurants and insurance and nursing homes, on healthcare. So within those categories, cruise lines are pretty interesting because you have to pay up front. The cruise lines have a backlog. That's a quality business. You know, a restaurant, your customers leave. You don't know who's going to show up tomorrow, right? That's true for investment banking as well. You don't know whether you're going to get an IPO window next quarter. And in the cruising industry, you have visibility for a cyclical category. That's kind of interesting. And boomers are stretching their legs. Part of the aftershock of COVID is people want more experiences. Cruising is one way they get that. I think people also want social connection too. Cruising is one way to access that. So that's one. So it's part of a theme I like called the baby boomer theme. I don't really hear people talking about this thing, but I think it's a real powerful theme, actually. Betting on baby boomers, which is really funny. I'm not a baby boomer. There's a lot of antagonism between baby boomers and non-baby boomers. But betting on the baby boomers, interesting idea, right? A lot of people talking about, well, there's a whole generation of people that don't own a home. The baby boomers own the home. What if you just bet on the baby boomers if you're in that generation? I think it's a good strategy. So let's talk more about Norwegian Cruise Lines. Let's double click a bit more. So one thing to point out is that the whole category is growing revenue. That's a good sign, right? I want to be in an ocean where the tides are favorable. I don't want to be in a dog-eat-dog world where the tides are going out, like processed foods, like Kellogg's, let's say, Kellanova, I guess they call that nowadays. Why do you want to be in a competitive market? I'd rather be in a growing market with not too many players. It's nice and comfortable. So in this market, you've got three players. You've got Royal Caribbean, Norwegian Cruise Lines, and Carnival. Royal's at the top end of the market, Carnival's on the bottom. Norwegian's been caught in the middle, actually. And in general, I don't like plays that are caught in the middle because they get dominated. Usually the folks that own the highest quality customer or are the lowest cost provider of a service in the industry, they tend to do best. Walmart's an example of the latter. Luxury brands are example of the former, like the Hermeses of the world. And usually you want to avoid the folks that are in the middle. Another example would be American Express on the high end or Capital One on the bottom. You know, the ones in the middle usually get dominated by the ones on the edges because the ones on the edges have a clear value proposition that's more targeted to that market. And then the edges can start to move inwards, right? Amex had Centurion, Black Card, Platinum Card. They start to go closer to mass market. They're partnering with Coinbase on this card, for example, to appeal to the next gen. And then you have the lowest cost providers that move upstream. Capital One is a good example of that, right? They acquired a regional bank something like 10 years ago. They acquired Discover. They're still adjacent to the customer. They just start going towards the middle, and the guys in the middle get squeezed. It's often what happens. So check out Norwegian Cruise Lines. This is a business that's got an ROE of 95%, by the way, or return on equity of 95%. So they're compounding book value quickly. But why is the ROE 95%? The ROE is that high because they have lots and lots of debt. Lots of debt. Okay. So high ROE alone doesn't mean it's a good metric. You can have high ROE, but if you have too much debt and you can't pay your bills, then that can be bad. I'll come back to that. So what I want to do is this. I want to validate first that, hey, is this business actually compounding book value? This is an excerpt from the Lumina ledger this past weekend, by the way, if you guys want to follow along or do a deep dive later. I'm sharing this on the screen now, but you can see the total common equity. This is the book value. This is actually how Warren Buffett would look at a business. He wouldn't buy this business, by the way. It's too cyclical for him, but that's okay. So in 300 million in common stock in book value, book value in December 23, December 24, 1.4 billion in book value. That's strong growth. That's due to the high ROE, right? Now, book value is your total assets less your liabilities. Okay, it's one way to think about compounding. Right? If you own a compounder, you should be looking at the growth in the book value. It doesn't mean that's intrinsic value. It doesn't mean it's market value, but it's a good sanity check. Are these guys are they at least creating accounting value? They're creating accounting value, according to this. The book value is compounding. I can see it growing. The higher ROE is expressing itself in higher total equity. So I like that. So far, so good. So what about this debt level? So we look into that. First thing I do is look at the short-term debt, the debt that is payable in the next 12 months, and you got to make sure they can meet their bills. So we want to look at available cash on hand. And you want to look at what comprises that. So we looked into this. We said, gee, half of Norwegian Cruise Line's short-term debt are customer advances. That's not a fortress credit facility. Half of their short-term debt are customer advances. In the same way that if you make a deposit at a bank, you've made a loan to the bank. Your deposit is a loan to the bank. That's not bad. It's great when the bank gets your deposit because they can turn around and they can make a loan. And that's how the bank makes money. And that's why banks have, pretty good business models. So those are prepayments, actually. So the short-term debt is elevated because of customer advances. Now, the other question is, again, like, can they pay off the debt, though? Well, we can measure that. You can look at their debt payback yield. So I'll pull that up here. And we can see that they're paying off about 5% of their debt each year. Again, this business does have a lot of debt to equity. So I don't want them taking on more debt, but they are paying off their debt. I want to see that. Do they have enough free cash flow to pay off their debt? If they want to increase that, or are they running on fumes, or do they have freedom to maneuver? And this is one of my favorite charts, by the way, is the free cash flow yield of a company. I look at this every name I invest in. It's a very crucial chart. You can manage earnings. It's hard to manage cash flow. This is the free cash flow yield divided by market cap of Norwegian Cruise Lines. It's around 11%, and you can see it's rarely been this high for this business. It's rarely been this high for this business. It's a way to measure value. If you're a fixed income investor, you can think of this as like the spread on the stock conceptually, right? If you're looking at a bond, you're looking at the yield to maturity as one measure of value. Or if you're looking at a mortgage bond, you might look at the option adjusted spread. In equities, you can look at the free cash flow yield. So if I pull up the free cash flow yield for Google, let's say, these mega cap tech companies will be much lower, around 3.5% right here. NVIDIA, it'll be even lower. The higher the multiple, the lower the free cash flow yield, right? About 2%. So, this has an attractive free cash flow yield, which means it has enough free cash flow to pay the debt. They're paying that debt down. We have plenty of free cash flow to keep doing that. So check. This is important because you got to make sure the left tail risks are protected. You got to make sure the left tail risks can be managed. If you solve for that, then good things should happen with this business. That's how I look at it. Your primary left tail risk is COVID happens, another COVID lockdown. If you cannot cruise, then these stocks, all of them, will get hammered, like they were hammered during COVID. Okay, so that's your main risk with this kind of business. I don't see that happening. So if anyone sees that, let me know. Apparently tourism to Wuhan has dropped precipitously, by the way. I talked to a friend of mine from China. She said they don't have direct flights to Wuhan anymore. This is called market response, right? The market is smart. The airlines say we're not flying to Wuhan anymore. No one wants to go there, right? So let's keep going. Now, the other thing you got to do is you've got to compare this asset to other names in the category, travel and leisure and cruise specifically. So let's go take a look at that. I'm going to jump to my travel and leisure theme. Okay. And if you see my screen here, you can see how within travel and leisure we have these subcategories. You have to be hyper organized. We've got categories organized by Vegas, by hotels, by timeshare, airlines, booking technology. And if I look at, I'm going to change my view here. 1 second. Okay. Some high level metrics. Let me call out a couple of key statistics for you here. So one is, from an earnings perspective, it's the cheapest stock in the category. And from an EV to sales perspective, it's fairly cheap as well. But notably, if you look out to years 2 and beyond, the earnings growth is higher than its peer group. Now, why is that? And this is where, again, like the understanding the business and what they're doing matters. So what Norwegian Cruise Lines did over the last year and in the recent quarters is they spent a lot of capex acquiring more modern fleets, more modern cruise ships. Capex is bad for stocks, actually. Capex is capitalized expenditures, investing in property, plant, equipment, cruise lines, foundries. That's all capex. Building a hotel, that's capex. Opening a new restaurant, capex. It's expense. Now, usually, hopefully it's a productive expense. So you make money on it. It's net present value positive. You get a return on equity on it. That's the basic idea. So that's why they took out the debt. They took out the debt to invest in these cruise lines. And that caused the stock to get cheap. But that was all borne by the legacy shareholders. The same way that when a company announces an acquisition, often the stock price will drop. That's an expense of the company. The legacy shareholders bear that when the news comes out. The new shareholders get to look to say, oh, this is great. They're buying a new company. It's cheaper now. That acquisition's priced in. Now I have a better asset at a cheaper price. That's interesting, right? So they're buying these new modern cruise ships to charge a higher price point. They price not as high as Royal, but higher than Carnival. Like a room costs, call it $1,500, let's say, for an experience, versus Royals in the 1900 or so, and Carnivals, call it 900-ish range or so. So they can charge a higher price point, closer to Royal, and they do have a premium brand. They can charge a higher price point and fill that out. We know there's demand from the backlog. So that should be an NPV positive investment, and that will then grow earnings. And that's why you see the earnings estimates are higher next year. As these cruise ships get delivered, they can put those into operation, fill out the cruise ship, and then make money. That's it. So that's why they've lagged. They didn't have the capacity and the appropriate product to charge a premium price. That's increasingly behind them, right? But this is a good example where it's not enough to look at the numbers. You have to see, what are they actually doing? What is the business objective, the strategy? What's their product offering? What customer are they going after? So let's take a look at more of these metrics. This is an excerpt from the AI tool, the Lumida AI tool. I'm actually show it to you live just so you can have a look at this. I'm go type in, I'm going to analyze the transcripts from Norwegian Cruise Line. So I type in the ticker here. This system is going through the last 5 transcripts, highlighting the most recent, and it'll give me the key metrics and the key quotes from management. There's a lot of valuable intel in transcripts. The alphas in the transcripts. If you saw Oracle's numbers, how they crushed earnings, went up 20%, whatever it was, look at Oracle's past transcripts, and you will see that that story was foretold in the transcripts. Take a look. Read Oracle's transcript this weekend. You see, I'm not saying go buy Oracle now, by the way. I wouldn't do that. But read it. Take a look at the transcript. Magnite we found by reading the transcripts, by the way. MGNA. We own that name in our passive strategy. So as another example of that. But take a look at this. So revenue, on the revenue side, the CEO said our first quarter met or exceeded all key expectations we outlined in February, demonstrating a robust recovery. Their net yield, it's like the return on the rooms, increased by 1.2%, up from 32% year over year. Their margins have improved. CFO says these results are indeed impressive as we are comping against exceptional growth in the prior year. We will maintain an optimistic outlook for the year. The occupancy rate was 101%. I have no idea how you do that. 101.5% occupancy rate. What does that mean? Like you had a roommate that you charged for? Like, I don't get it, how that happens. But answering that question isn't material to the analysis. So I'm not going to focus on that. Cost per capacity day, the net cruise cost excluding fuel rose by only 3%. So when oil started to fall, we started buying more of this name and other consumer discretionary names post the Iran-Israel conflict, because oil is a key input for this business. So it set up the timing for this really nicely. When oil started falling, buy consumer discretionary names because they're all going to benefit from that. Oil is in everything, you know, apparel, furniture, drives auto, drives cruise, airlines, all the rest. So that set up a good timing around this. Let's talk about booking trends. Advanced ticket sales increased 3%. Capacity for the year is up 5%, indicating tighter inventory management. New ship deliveries. I was talking about this earlier. This is their capex spend. The Norwegian Aqua launched successfully in Q1, marking the beginning of a fleet modernization phase expected to enhance guest experience while driving profitability. That's what I was talking about earlier, right? Getting modern cruise ships that can charge a higher price point to the boomers. So that's what our AI transcript analysis is saying. What else? You know, there's a lot more in our tool. I won't go through all this. Talks about, you know, certain themes that they find. European travel hesitancy on booking. So Europeans are more reluctant to travel to the United States for a bit. I think they'll get over that. And then there's some excerpts from their Q&A. So how do you think about the ROI of the investments you're making? It's a question. And the answer of management, we absolutely believe these investments are more market to make the business more marketably. We quote, absolutely believe that it can drive price on the cruise and drive onboard spend. So management's very confident. You know, you have to assess that. It's not often that you have management that's not confident, but the story appears to hang together. Sometimes management is not confident, by the way. Listen to the earnings call for like Keurig, the brand that owns Gucci. Management is not confident on that earnings call. Right? There was a call 3 quarters ago, I think it was 4 quarters ago, where they apologized to shareholders. So yeah, you know, be skeptical, but keep an open mind also, right? What I'll do in our tool also is we have the AI, we'll build a bull bear case for us. This is based on a lot of information that we feed it. It's like the flux capacitor we taught her how to think a certain way also. This is not something you get just by using GPT. But, the bull case, fleet expansion, as I mentioned, the metrics are good. It's got cost management initiatives as well. And the bear case is the debt levels, which we talked about. And so I believe that's most of the story. And I think the other bear case would be if you have sustained, or if interest rates go higher for longer and above where they're currently financing. If they have to refinance their debt at higher interest rates, then when they roll over their debt, that would be a drag on earnings because their interest expense would go higher. Right now, rates are going lower. I think when Ray Dalio, those videos went viral 3 weeks ago about the fiscal debt bomb, that was a top in rates. These CFOs are pretty savvy. They know when to refi. They'll take advantage of those opportunities. All right. So that's my thesis on the name. If you look at I think also look at things technically is a good thing to do. Also, is there a bid for the name? Is the trend up? We'll start with their peer group, Royal Caribbean. These cruise lines have done very well overall. Like Royal Caribbean's done really well, right? It's at 20 times forward PE now, 24 trailing. It's more expensive than Google. This is really riding more momentum now. It's more momentum than fundamentals at this point, right? So if we look at Carnival Cruise Lines, same story, a lot cheaper. From an investor perspective, NCLH is a longer term idea, has more room to run than the other two. That's why I would look at it. So I can park capital in here and wait 1 or 2 years, and I think it'll do fine. I can get long-term capital gains, etc. So that's our thesis on Norwegian Cruise Lines. But overall, I'd say that there are quite a few interesting names in consumer discretionary, in consumer finance, in the banks, in non-bank consumer finance. These are names I've talked about before. We run a daily process. We find more opportunities than we have capital for because we're allocated. So that's usually pretty constructive. What else? Some questions. What are your thoughts on Texas Roadhouse? I prefer Chili's Eat, which I shared about a month or maybe 2 months ago. If you guys were listening, it's done really well. I think it's about 180, 179 now. I love Chili's as a restaurant play. It's cheaper than all the other ones, but it's got a good story around earnings growth. They had this turnaround that's working. Most turnarounds don't work, by the way. The turnaround's working. Texas Roadhouse. Let's give it a look. I'm sharing my screen here. My friend Angelo Robles clued me into Texas Roadhouse. I don't own it. I don't know. I prefer Eat. I prefer Loco. It's definitely set up for a good entry. I'll say that much, right? But it's more expensive than Eat. The momentum isn't as strong as Chili's as well in terms of the price return. Maybe isn't set up that well, actually. I don't know. It's got some lower highs. We'll see. It's not. I think it's a fantastic franchise. I'd love to see one in the my local area and check it out. I love Texan brisket, by the way. My doctor doesn't love it. I love it though. It's really fantastic. Good little treat now and then. Good barbecue during the summer. So I think we covered off on that. Let me see if there's anything else to share with you. One other thing I'll call out is that we do this Telegram group. I share different thoughts and ideas in here, what we're reading, what we're looking at, macro views in our Telegram group. And in this Telegram group, by the way, we have a real-time news feed. We actually created a news feed called Trump Watch. How awesome is that? It's like, just tell me what Trump is saying, okay? That's all I need to know. We have a feed that tells you what Trump is saying, and it has a red circle if what he says is bearish, and a green circle if what he says is bullish. So we're having fun with that. Our AI tool will process earnings and then share a short summary in the Telegram chat. And you can find good ideas just going through and reading that. And now and then you'll find really interesting businesses that are overlooked. And in the chat areas where I share different thoughts, and there's some very thoughtful people in that group also. So we're still improving and iterating this. Feel free to check it out. We post curations in here as well. There's a channel for funny videos and memes. And we have a nice little community here that people contribute to. But it's a nice one, nice little meme. This is a farmer talking to a horse. AI joke. You won't lose your job to a tractor, but to a horse who learns how to drive a tractor. That's a good one, right? All right. What else? Any questions? Oh, nice. We got some questions here. I don't know these names. Thoughts on DEO and PEP? I don't know these names. I don't know. Can't help you. Sorry. It's okay to say I don't know. Nothing wrong with that. The most dangerous, dangerous words in the English language are trust me, probably. That's probably the most dangerous. That's why you need decentralized encrypted systems that can verify. That's what you need, right? So, let's see. Other thoughts? Food store stocks. I'm not focused on that right now. Food store stocks used to be growth stocks, like in the 1920s or so. That was the hot ticket that investment bankers like Charles Merrill at Merrill Lynch were taking public, the Krogers of the world and the Safeways of the world. And now they're, we call them consumer staples. That'll happen one day with all the hot stocks that you see around today, right? If you were around in the 90s, you had like iOmega Disk Drive. That was a hot company, right? Excite, all that. So, that'll happen to a lot of the names out there. I will say this about Cathie Wood, by the way, ARK. They have transformed that portfolio. They actually have some good businesses in there. They're more fundamentally oriented. They have businesses that by and large make money. You might not like the valuation. It's pulling back today on a day the market's up. It's probably overextended. I'm not saying own it or not. I'm just saying that Cathie Wood has changed her approach to investing for the better. She's also embraced Twitter momentum stocks rising. I think ARK is actually a bet on Twitter momentum at this point. They don't have as many names. There's unprofitable story stocks that are going to dissolve. ARK used to be my favorite hedge in the last 2 years. It's no longer effective for that. I cannot use it in that role. And if you have a read onto how those strategies and themes are working, then you might use it a different way. So let me share a few other things we're building out, by the way. We're building out agentic AI technology. There's so many cool things that we're building and having fun with here, but check this out. So I think the future, you're going to have all these financial advisors and Merrill Lynch and JP Morgan, Goldman Sachs are all going to get disrupted by AI. You're going to have advisors that talk to you on your phone through an iOS app whenever you want. They'll tell you how your portfolio is doing, the questions you want answered. They'll remind you of key events on your terms when you want to. Maybe when you're walking into the bank, it says, oh, by the way, you got to fund your kid's 529 account. That's the future of wealth management. AI avatars are a key part of that. So we're building out these AI avatars. Check it out. If you've been following my Twitter feed, I've been experimenting with Greek mythology themes. We're working on a July 4th video to celebrate the independence of the United States of America. So stay tuned for that. That should be a lot of fun. But I think this is extraordinary technology that is going to transform the media business. I mean, look at why Meta is doing well and their competitors in the old school world like Omnicom or Publicis, WPP. Those stocks are in bear markets. The digital world is more relevant than these old school kind of marketing techniques, and AI is accelerating that. Did you see the Kalshi ad? This ad had 3 million views. Let me play for you. 3 million views, and it was made with $2,000. Okay. This is the future. So we're building our own. We're building a few different ads and having fun with it. We have an intern named Lev, who's the best intern of all time. Okay, here we go.
Indiana gonna win, baby!
We're in Florida asking people what they put their money on. I'm all in on OKC.
Indiana got that dog in them.
Will egg prices go up this month?
I think we'll hit $20. How many hurricanes do you think we'll have this year? Kalshi lets you legally trade on anything, anywhere in the U.S.
OKC.
Indy! OKC!
Now, there are a lot of limitations. That was both Google VEO3. A lot of limitations of Google VEO3. You can't have a clip more than 8 seconds long. So you'll notice that in that video, there's no clip more than 8 seconds long. They just do non sequitur jumps. They have a music overlay to create continuity, and they make it work. So I think you're going to see a lot more of that happening. We're building avatars on our side to generate content on demand. I think CNBC is going to be taken out with these avatars too. We're building all this stuff. So stay tuned for that. We have 5 developers going to 6 developers, and it should be fun. When do you admit you were wrong on SoFi? Dude, take a look at Dave, man. First off, this is a weird comment, dude. Don't hate. You get out what you put in the world. Don't hate, man. Live and let live. It's a good attitude to have towards other people. My thesis on SoFi is you're better off buying Dave, and SoFi is overvalued, and it's not a high quality business. All that's true. In fact, the 4P is negative on the business. That doesn't mean an animal spirits name cannot rally. That includes SoFi, right? In fact, in Q4, I was saying animal spirits names will go up. That's just generally what happens around that time frame. But if you look at Dave versus SoFi, Dave has destroyed SoFi. If you were long Dave and short SoFi, you'd be up multiples in the last year, significant amount. It's not even a comparison. I have a better idea than Dave now, though. Since you brought that up, I will share a gift to you, my friend. If you're in SoFi, you're better off buying Bread Financial. Okay, I own this name. Let's see. Bread's been doing real well. But this is a consumer finance name. They're linked to non-bank consumer lending. And I've talked about this name before. I'll be brief around it. One is they have good credit underwriting metrics. The DQs are declining, strong management team. Ralph Andretta, ex-American Express, ex-Bank of America, and Perry Beberman. I used to work with them both, actually. So I've seen them in action. I know they know what they're doing. But beyond that, the business model, I think, is quality for this kind of category. They're smart enough not to get into chasing bad merchant categories and getting upside down. That's the mistake that these fintech lenders will do, is they can't distinguish good credit risk from bad credit risk. And the valuation is good. The free cash to market cap yield is 69%. The price to free cash flow is about 1.4 times. It's up 32% in a year. So people that say you can't make money with value stocks are wrong. I just showed you an example. I just showed you another example of that. Norwegian Cruise Lines will be another example of that too. There's definitely a role for growth stocks. It's not an either or. I don't think it's an either or. I think going meta and thinking about the role of both in your portfolio, along with quality compounders, and stocks that have high free cash flow, low P ratios, and buybacks. That's another kind of strategy. And momentum. I think that's the way to think about it, actually. Those are kind of the principal strategies I try to orient around. And what's my asset allocation across those? And then within those, what's the right type of expression? And when are those strategies likely to work or not work? That's important too, right? So in a risk-on environment, the momentum can do better. Maybe in a risk-off environment, quality compounders like insurance can do better. If there's more volatility, they'll probably do better, etc. Right? So those are some thoughts. I think we'll call it a wrap. Hope you all had a good one. Remember our friend Ralph Waldo Emerson, and continue to take some time to reflect this weekend. All right, be well, enjoy time with your families. Take care. Till next time.